Hi, everyone. Welcome to another Sip and Solve. My name is John Krickus. I'm a Senior Product Manager with Experian Business Information Services. I'm responsible for our business scores, and I work with clients to utilize our scores. I've worked for nearly a decade in managing both first and third-party receivable collections. Today, we'll be walking you through how you can use analytics, scores, and data to improve collections in these challenging times. With me today is Andrew Moore. Andrew, would you like to introduce yourself?
Sure will. Thank you, John. Hello, everyone. My name is Andrew Moore. I am a senior consultant within our Commercial Data Sciences group, and I support Experian's commercial credit accounts, and I am excited to be joining you today.
Terrific. Thanks, Andrew. So our topic today is about how to maximize receivables in these very challenging times. Because as we've seen from our clients, delinquent receivables are starting to grow, and they're starting to grow at a significant rate. And in this atmosphere, many of you probably have the same resources. You're not getting additional resources to deal with this new level of past due accounts. So we're here to talk today about some ideas on how to resolve this dilemma. So some key questions as you look at the situation is, what is going on with your delinquent accounts? How much are they increasing? Some businesses may not be experiencing as dire circumstances as others. So what's the cash flow needs of your business? And importantly, as you match up the needs, the increase in delinquency, what type of resources do you have? And in all likelihood, how are we going to have to use existing resources in order to maximize our receivables and our collections? Andrew, I know you work with clients every week. Can you touch on a couple of the events that you're seeing out there right now?
Yeah, thanks, John. So, and honestly, they go very much in line with what you just said. I think the key theme is what I was doing a year ago necessarily isn't the same thing that I should be doing today. Obviously, for all those on the phone, we know that the economic landscape has changed. And so a lot of the conversations I have is around what resources do I have at my disposal? How do I effectively and efficiently deploy those resources in the current economic environment? And then also, obviously from a sales support standpoint, what solutions does Experian have to complement what I'm doing today? And I would say from a frequency standpoint, I have these conversations weekly with clients.
Terrific. So as we look at the situation that we're facing, we're going to talk about a traditional prioritization of receivable management. We'll call that the base strategy. But now we're going to want to assess that strategy given the tough circumstances that we're all in with the economic and health crises. So we're going to identify two areas for adjustment to help us out in this situation, and then finally to act upon that plan. All of this is meant to maximize cash flow, to maximize collections. So let's talk about a traditional plan, but then you see to the right, we have a question for you. Are you able to follow this traditional plan, which is meant to maximize cash over time, or do you need immediate cash? So what we've done here is if we were to take a look at a receivable portfolio, we would suggest using two score measures. So now we're going to use intelligence, some analytics, in order to help prioritize our limited resources. Across the top, you see our credit score, IntelliScore Plus. We also have Small Business Financial Exchange, Small Business Credit Share. Those are consortium scores. They're all predicting delinquency. A high score means they're at low risk of delinquency. A low score means they're at a much higher risk of paying in a delinquent manner. We're going to add to that our Financial Stability Risk Score. This is a score that's predicting business failure. Again, a low score means that there's a real high risk of that business failing compared to the high scored accounts. So when we put those grids together, we've now put accounts into 4 buckets. Now, traditionally, we might focus on the green bucket. So they're going to pay slow. They have a low score for IntelliScore Plus, but they have a high score for financial stability risk. So they're not going to fail in all likelihood. They have a very low likelihood of failure. So if traditionally you're trying to maximize cash over time, you might focus your limited resources on accounts that are paying slow but will pay. However, if you need immediate cash, the focus may now need to be on the yellow or gold group. This is the best group generally for self-cure. But again, if you are dealing with businesses, if a large part of your portfolio is with businesses that are in travel, entertainment, restaurant, that are affected, especially in this current crisis, you may now need to go after the high scoring accounts in both areas because you need cash, and those are the businesses that, given their situation that all the businesses in those industries are in, will have the best chance of being able to produce a result. So that's where, depending upon the answer to your questions that we laid out, do you need that immediate cash? You're going to go after the high scores in both areas in order to generate collection results.
Yeah, so going back to an earlier comment about my interactions with clients, when we talk about implementing a score-based strategy, I think there's three key themes. And for this audience, I'm hoping that these three resonate because I really do think the implementation of a strategy is applicable across multiple business functions. So whether you're in first-party or third-party collections and or receivable management, I think the key themes that resonate are maximizing recoverable yield, or how do I get the money that is owed to me most efficiently and effectively? And then how do I manage my dollars at risk if I'm looking at this from a portfolio level? Where does my risk lie? And then what action or what strategy do I deploy to protect those dollars? And then lastly, I think it's applicable to all levels of the organization. So, from the highest level, if you're thinking about this from a P&L standpoint or looking across your portfolio to figure out, okay, where does our risk lie from a portfolio standpoint, all the way to a collection manager that's, on the front lines pulling the levers or allocating the resources. How do I go after the dollars that are owed to us to in turn maximize my recoverable yield? So again, in my conversations with client from a consultant standpoint, these are three key themes and the audience in which I believe this, implementation of a strategy is pertinent to. So having said that, John, do you want to touch on the benefits of implementing a strategy?
Yes, thanks, Andrew. And, we talked earlier about the dilemma of having a significantly increased workload, and in all likelihood, you have the same resources. And I've been there. I've worked for about a decade in receivable management, both in first party and third party. And the whole part of a receivable management effort, given the huge volume of accounts you're dealing with, is you want a lot of those accounts to self-cure. Well, given the situation that we're in, and again, as you assess your portfolio as to how much you have to depart from a traditional strategy, you may need to optimize your collection accounts. So, for example, accounts that have low likelihood of payment or and are a high likelihood of failure, you may want to accelerate out to legal action or out to credit line freezes or to take other action to reduce your costs in dealing with them so you can optimize your collection efforts by focusing on the clients who can pay in order to generate that cash flow. That is one of the adjustments that we would need to make in this environment. And another one involves our COVID capabilities that we've developed over the past couple months. Andrew, in our decision sciences area, could you discuss what our decision scientists came up with?
Yeah, so one of the things that I think is complement to any score-based strategy, or one of the solutions that can complement a score-based strategy, is the evaluation or the overlay of our COVID-19 risk index. And so experienced COVID-19 risk index, I should say. And so this index is a combination of geographical caseload across the United States in combination with industry risk. So think construction that was deemed an essential function versus restaurants and retail. And so through this risk index, we can provide a severity level from high impact to low impact, which allows you to even further segment, even within score bands, your portfolio and just give you even a deeper granular or more granular view of receivables management, collection strategy, and the application of that intended strategy.
And then the other complementary product that we have for these delinquent receivables is our commercial recovery score. It was just launched last year. And normally with scores, we talk about the bad accounts at the bottom end of the score scale. So in the bottom of 20% of scores, how many of the bads were we able to exclude so you can have an 80% approval rate and yet get rid of 50% of all the potential bad accounts? With the commercial recovery score, we're trying to help you out with severely delinquent accounts. And here we're looking at the good scores. So the good scores, as you see in this chart, and these were very severely delinquent receivables, we were able to collect 72% of the potential dollars in the top 30% of scores. So at the bottom end, you would really save a lot of your effort. And Andrew, if you could go into detail on what our commercial recovery score capabilities can do.
Sure, thank you. So again, in commercial data sciences, I'm a big supporter of the commercial recovery score and the associated analytics. And so what you're seeing here is highly summarized view of an output that we can provide on a client portfolio. And what I like to say here is this is where we quantify the concept. So we've been talking a lot about the application of a strategy and so on and so forth. Well, here's where we get into the numbers or the statistics and quantify how do you apply that. And I think there's three key things. So one, in utilizing a score, i.e. the commercial recovery score, we want to create segments that more accurately and efficiently identify and apply treatment strategies. So you have your tool chest. Where do I apply those strategies to maximize my recoveries or minimize my risk? Secondly, we want to balance the probability of collection. So looking at the credit file, we want to balance the probability of collection with the placement amount so that we're optimizing the dollars that we recover. And I'm going to show you a visualization about that in a moment. But to John's point, 40% of my placements, I'm recovering 60% of my dollars. So we want to create that balance. And then lastly, we want to isolate the lowest percentage placement dollars to take some final action. Because on that bottom 10%, would you be better served by focusing your resources elsewhere? Take that bottom 10%, take some final action, and then focus the resources elsewhere to go after other dollars. And this is one of the views I like to show. I think this is a really good slide for a number of reasons. So this is a depiction of what you saw on the previous slide, but this gives you a visualization of where your opportunity lies. So again, utilizing the commercial recovery score, the whole goal, as I like to call it, is to identify the opportunity on the margin. So on the right-hand side, you see a very clean distribution, your largest percent of your payments or placements, a very clean line is identified in the gray, clean score curve. Those are the consumers that have commercial accounts that have a high probability of paying. That's your low-cost effort, email, auto dialer, so on and so forth. Again, I think the opportunity lies on the margin in the orange and the yellow. You can still see some high scores. There's some still high dollars at risk. If you were to focus your efforts, so take the commercial recovery score as a complement to as a complement to your other tools, and if you can identify those statistically, you can quantify the dollars, and you can allocate resources strategically in a score-based strategy to go after those. That's where you can really move the needle and advance your recoveries or protect your receivables. That provides you a very clear line of sight into implementing a strategy. And then lastly, in the red section, you can see very low score range, very low dollar, or very low score distribution, very low dollars as identified in the orange columns. Why focus your resources there? Would you be better served by focusing your resources elsewhere to really achieve optimized results? So again, I think in terms of commercial data sciences being able to provide something and utilization of the commercial recovery score, I think this slide makes a very compelling argument for the utilization of a score-based collection strategy or receivable management strategy. And then lastly, from talking about this from a product standpoint, so we're talking about the commercial recovery score. The commercial recovery score is much more than just a score. Thinking in terms of the overarching solution, one of the value adds is the skip tracing information that Experian's been able to append to this offering. So what we've done is we've consolidated all of the data within Experian's robust database, and we're providing that to you in one output. So not only are you getting scores, you're getting all the additional information that we have related to your commercial accounts. Within that, we're including up to 5 officer contacts, as well as 10 additional location contacts with all address and unique phone numbers. And to put that in perspective, or put the value of that in perspective, I want to give you a production result, and I'll be brief. So on a client validation that I performed, we provided 30% net new contact information, of which 60% of the 30% resulted in a net new contact. That in and of itself, just the robustness of the data, was enough to deliver a positive ROI, which resulted in the client sending a subsequent batch. But I think this creates immense efficiencies in terms of your self-sourcing of your own data from 3 to 5 different sources. So again, think of the commercial recovery score not only as a score, but an overarching solution to really help you implement a strategy to achieve your results. So John, I'll turn it back over to you.
Andrew, that was terrific. Well, that's all we have for you today. Thanks for spending your coffee break with Andrew and me. Hopefully we gave you some ideas on how to improve your receivable management and collections. If you have any questions or want to learn more about what we talked about today, especially assistance from our decision science and analytic area, you can email us at commercialdata@experian.com. And you see it listed there on the last slide here. You can also send us a message in the exit survey. And if you want to get notified of future sessions, please join the list, and you can see the link there. Thanks again, everybody. Now let's all get back to work.